You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Tuesday. Today, I want to go back on my Lira account. That is getting so close to another milestone that would be hitting the mark of $300,000. And that's kind of crazy because at the end of 2017, so late August of 2017, I got a check from National Bank as I quit my job and got $108,000. I invested all between the September and December of 2017, and today that Lira account, which is a locked-in RRSP, in other words, a tax-sheltered account where I cannot add capital. So it's only total returns, whatever capital gain or capital loss plus dividend, and that's it. So I started with $108,000, and now it is showing a balance of $298,000. So it's hopefully question of days. I don't want to jinx it. Maybe we're going to head into a correction and I will not see the $300,000 in value. But yeah, we're getting there. And I'm not doing this podcast to brag. Actually, I just want to look back and reflect a little bit on how it happened. Was it like just stock selection or because I'm like such a great investor? And I don't think of that. I think I'm a decent investor, but there are reasons, very clear reasons why this portfolio is doing so well. The first one actually is just the natural power of compound interest. $100,000 technically should double roughly every 10 years. So assuming a 7% total return on a 100% equity portfolio. It's not too demanding. So 100K every 10 years should double. So we should go from 100, 200 to 400 in 20 years. Right now, I'm definitely in advance, so it's faster. But as I said, we have been lucky on the market, and that probably could explain a little bit of that overperformance. So while being invested all the time is the first reason why this portfolio did well, it was just like pure math. You invest, you stay invested, and then boom, slowly but surely your portfolio grows. Why it grows so fast, so actually twice as fast as expected? Well, Mr. Market has played a big role here. If I look at the total return of the US market between September of 2017 and November of 2024, I see a total return of 172%. So I'm still doing a bit better than this, but definitely I rode that wave. And on the Canadian side, the TSX, if I look at xiu.to, this ETF is up 107%, so more than double its value. So definitely staying invested was the first reason. The market being very generous with us over the past 7 years has been the second reason, but it's not enough to explain the performance, right? It has to be something else. There's of course, a combination of factors, but I don't think that just staying invested and having the market on your side is enough to perform like that. So a third reason why the portfolio did so well, I never changed my strategy, like ever. I've focused this portfolio on a 95% actually approach towards dividend growth investing. Right now I'm 100%. But from time to time, I took some speculative plays in this one, especially at the beginning. I bought Shopify after there was a short report, and then I sold it for a hefty profit. I did a move on Qualcomm similar to this. I bought Canopy Growth and sold it at a 50% profit as well. So every time that I did this kind of like speculative play, it was always less than 10%, and actually each play individually was less than 5% of the portfolio. And every single time, what I did is I used a stop sell. So whenever I had a quick win on those speculative plays, because the idea was not to keep it, I was really fast to put a stop sell and just to protect my profit. Just to be clear, I never put stop sell on my regular holdings. So that 90 to 95 to right now 100% for that portfolio, all my positions are 100% geared towards long-term hold, all dividend growers. And for them, never put a stop sell. So sticking to the strategy, having a core view of how to manage your money and moving forward, make things easier to manage because you spend less time watching your portfolio. Actually, I spend zero time watching it day over day because the strategy works. I just follow it and it makes it so easy. So sticking to the same strategy instead of like selling my stocks to go for an ETF, selling that ETF to go for covered calls, selling covered calls to go back for momentum, or trying GameStop and meme stocks in 2021, or going to another strategy. That is not what I did. What I did was I focus on companies increasing their dividend every single year. And that also helped to do a great return. The other thing, because then again, sticking to the strategy, yeah, your strategy works, but maybe it's not going to be enough, right? It's more like a thing that if you keep on switching strategy year over year, just to look at back what was the best thing the past 5 years, and then you just switch, you're never going to get momentum in your portfolio, and you may enter and exit strategies at bad timing as well. So that's the reason I stick to those. Again, probably not enough to explain the performance. So I digged a little bit deeper and then I found something very interesting. I just told you I do not put stop sells on my portfolio, on my core holdings, right? Well, here's the thing. When I look at my portfolio today, I have several companies showing more than 100% return. So companies that more than doubled, excluding the dividend. So Alimentation Couche-Tard, Apple, BlackRock, Microsoft, Texas Instrument, and Visa, they all show more than 100% return. And actually, it's a lot more than that. So for Apple and Microsoft, we're thinking about like more than 400. We have like a few in like the 200s. It's huge, right? It's huge. And then when you include the dividend, we have probably other stocks that are pretty close because I have National Bank at 78, excluding the dividend, Royal Bank at 84, Brookfield at 76, Lemaitre Vascular at 87, and Starbucks at 78. So what's the, and again, I'm not telling you, oh, wow, look at all my great picks. But the point here is, once you have done a great research on a company and you have a high level of conviction, it's time to hold onto your winner. So I don't sell them unless they become too big. But if not, I just revised my investing strategy, my investing thesis. And if the thesis is still valid and the dividend triangle, the financial metrics continue to back that thesis, I just keep those stocks. And by keeping those winners, well, that also allowed me to make a lot of mistakes because for each Algonquin, I had an ATD. For each Sylogist, I had an Apple or a Microsoft that compensated those losses. So to summarize this, the first thing is the power of compounding interest. So just by staying invested, you should reach your financial goals. The second factor was Mr. Market. So the market has been generous. By staying invested, I've fully participated in this growth. The third thing is I stick to the same strategy. So instead of like going back and forth and wondering always what would be the best strategy with the best outcome, I just selected one strategy that have a decent outcome and just stick to it. So it's not that my strategy is the best one, but the fact that I never get away from it and I always stick to it makes the difference. Finally, holding onto my winners compensated for my mistakes, helped me to outperform the market and to ride those waves, because instead of like selling after a 50% profit or 100% profit, I kept holding on to those stocks to show like 200, 300, 400% return, which is definitely the magic of what happened in that portfolio. If you want to know more about how I invest and my strategy and to learn like the financial metrics I look at and how I manage my portfolio, I invite you to subscribe to a recent to my next webinar, Dividend Income for Life on November 28th, and there will be a replay for every attendee, so you don't have to watch it live. You just have to register. And to register, well, you go to moosemarkets.com/webinar, or you go on the show note and you'll see the same link. So moosemarkets.com/webinar, 100% free. I will answer all your questions during a Q&A after I share with you my investing strategy for the long term. All right, Moose, that's enough for today. We're going to talk again tomorrow, and until the next time, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.